The Japanese yen hitting new fresh lows, US dollar, Japanese yen, that exchange rate hitting new highs earlier this week, above 159 in the spot market, which are highs dating back to July of 2024, blowing through those 2025 highs. So wanted to take a minute to just kind of prepare and package a little thought experiment around what it would take for the yen to recover, because there's so many pieces around this currency right now. So let's get into it. And this could, formulate some trade ideas for you across multiple time horizons, because there are multiple potential opportunities for both sides, long and short, the Japanese yen. But here's a little look at the price action today. A pretty notable sell-off of a little over 0.5% in this dollar yen off of its highs. But yesterday, a lot of alarms sounding in the Japanese hemisphere, because not only is it this US dollar Japanese yen exchange rate, but we can look to all of the yen crosses that are offered at tastyfx, like the euro yen, the pound yen, even all the way down to the Mexican peso yen, to see that this yen weakness is broad-based, not just a US dollar story, and has a ton of moving parts around it. But the 160 level that we hit back in July of 2024, we'll take a tighter look at it in a second, but that's really the only time in the past 30 years that we've been at this 160 level. And at that point, and even in some instances before that, we see some Bank of Japan direct intervention to try and regulate this. So we'll look into that. But the main call out here is that even though that might be the headline, 160 possible intervention, we take a look at the left of this graph and you see that it was above. This is a daily chart, so each candle representing one day. We spent multiple days above 160, pressing all the way close to 162. So even though if you are a contrarian, you could say historically this is at an extreme. When you're trading leverage products, it's also very important to note that even if a change is inevitable in the long term, it could press even higher and stay there for an indefinite amount of time. So let's look at, let's zoom in on the next slide and take a look at the intervention risk in particular. Last time we were here, July 2024, we've had some recent headlines from the ministers of finance saying all options are on the table, not counting out possible intervention. And as we know, the main drivers for them to try and step in and regulate the exchange rate, trying to bolster this yen, is not the absolute price level, but rather the velocity that the yen is losing purchasing power as a main driver in terms to step in. But here, looking at this graph of July 2024, you see that from a trader's perspective in the moment, it's not as clear-cut a story as you might think, because looking here, when we were at near 162, we started to get that yen sell-off that lasted about half a month there and took a ton out of this US dollar, but we didn't get until the end of July here an official kind of statement from the BOJ saying that we've pumped billions into this market to try and regulate the yen. So it can be very opaque in terms of real-time intervention risk, because they might not disclose it for multiple days, and the actual intervention can be conducted over multiple days. So you're really just looking for huge moves quickly as a ton of capital is injected into these markets, and you won't really have that confirmation for some time in some cases. So it's important just to know that even though intervention sounds like a one-off move, it can be distributed over time, and is pretty opaque and is designed not to reset markets, but really slow momentum and give some of these other fundamental aspects time to regulate this market over the long term. So on the next slide, let's look at what actually could cause the yen to recover long term. And that's, less to do with big players in these spot markets, but more to do with the narrowing interest rate differential. As we know, the U.S. is coming down, but what's pressing the market to new highs right now is, the data that's coming in isn't spelling the narrative of, okay, we're safe to keep coming down. The kind of base case for murky data or data as expected is just keeping rates as is until we see something shocking to the labor market or inflation coming down more than expected. And the main driver from the Japanese side is the Bank of Japan supposed to be hiking, but not doing so right now. And we'll get into that in the next slide. But then aside from all of the risk premium from a political side is just that carry dynamic as well. And that's not a fundamental driver, but can really reset these markets in terms of magnitude. Once you get some of these leverage positions unwinding, we can get larger moves than we would get to the upside in this market and help the yen recover long term. And so here's just a snapshot of U.S. overnight interest rates and Japanese overnight interest rates. And you might be caught on, the absolute values here of, okay, we need the Bank of Japan to hike a couple more times, but that really only gets us to 1%. That interest rate differential will always be there. But in terms of, the carry trade and financing larger positions, it's really about when this differential is at the apex and when it's condensing. You don't want to put on, new financing trades when this differential will squeeze tighter, even if it is always there to maybe 2%. And so this is just one to watch. And from the Japanese side, it really is down to sustainable economic indicators. So even though it's not normally a high-level economic data release, for Japan, looking at wages and wage growth in particular from a country that, imports a lot of things, also services, inflation, getting some of those indicators to a sustainable level and getting the kind of hike that spurs from economic growth and more sustainable certainty can really add some flows back into this yen. And again, that Fed timing, because it's so important for not only the U.S. side of things, but Japan being a large U.S. debt holder, that kind of correlation tends to be a lot higher in this pair as well. So looking for any sort of rate cuts priced in more than expected, more than the 1 to 2 over 2026, could start to shake this pair out more long-term from a fundamental perspective. And then, of course, on the next slide, there is, how do we get here? And the potential upside case for it is this new Japanese political regime in which now the buzzword is the Takaichi trade, which, of course, is the Japanese prime minister. And that's how we got here from, the likes of 150 all the way to perhaps 155 was on the election of this new prime minister, which, if it had their way, would lead to a lot more fiscal stimulus and a lot of policies that would, in theory, weaken the yen and strengthen equities, as would be good for them on the domestic front. But this has really taken a leg higher because of recent developments from this snap election, might be called. Whatever the political nuances are, there's a chance for the political regime to get even more power, a stronger majority in the coming future. And so traders latching onto this weaker yen in recent weeks on the perception of this trade getting some more legs. So if that legislation's passed and this government wields a little more power, there's also risk to the upside for dollar yen. And like we said with the intervention, that could slow momentum. But from a fundamental perspective, we could see this go through to new highs as we enter, a regime from the U.S. side and the Japanese side that perhaps we haven't seen before. So historical context out the window for those that are predicting a higher U.S. dollar, Japanese yen. But that's what I'm looking at. Kicking it over to the key takeaways. Obviously, for short-term traders, looking at that intervention risk, being attentive to when moves can be more aggressive to the downside than the upside from some of these liquidity injections. For those bold enough to trade intraday, perhaps some opportunity to the downside playing on some of those moves, but then zooming out to those fundamental indicators for long-term plays of, not only calling for the yen to get stronger just because we're at historic lows. If you're trading that, you could expect to be in that position for a lot longer than perhaps anticipated, because the fundamentals right now don't necessarily dictate a V bottom for the yen. But of course, all that could change with some of these economic indicators that come out, and even from the U.S. side, if U.S. rate cuts are to come, could help regulate this yen over the longer term.